Welcome to Market Pulse by Orestes Capital, your daily briefing on the key market moves, sector trends, and investment themes shaping the day. Today is Thursday, July 30th, 2026. We're Elena and Marcus. This episode is brought to you by Bank Atlas, where the risk of every bank is quantified via proprietary grades and analysis. Learn more at bankatlas.com.
Moving to today's data, we have an incredibly complex session to unpack for you. If you just glance at a financial news ticker today, you might think the global economy was firing on all cylinders.
Right, it looked like a massive boom on the surface.
Indeed. But digging into our daily desk data reveals a pretty massive illusion hiding in plain sight.
Yeah, and we are tracking 4 critical themes for you today. First, this severe divergence in equities, where, an explosive technology squeeze just completely masked underlying market deterioration.
Correct. And second, we have deeply concerning macroeconomic data pointing straight to a stagflationary environment, which is pushing the long end of the bond market to a breaking point.
Right. And third, these international shockwaves, mostly highlighted by a violent government intervention in the Japanese yen and a massive surge in gold.
And finally, we're seeing a structural regime shift in the technology sector. It's this transition from blind enthusiasm for artificial intelligence to a strict demand for actual measurable free cash flow.
On that point, let's establish the proper baseline for you regarding today's price action, because the headline indices, they present a highly distorted picture. The S&P 500 closed up 1.66%, landing at 7,437.63.
And the NASDAQ 100 surged a staggering 3.36%. If you stop reading there, it looks like a historic bull run.
Yeah, but when we look at our daily desk data, we see the equal weight S&P 500 actually fell 0.16% during this exact same session.
Understood. That means if you strip away the market capitalization weight of just a few massive tech companies, the average stock in the market actually lost money today.
Exactly. So our core objective is to dissect exactly how and why the structural illusion occurred. Let's start with the macroeconomic environment and the global interest rate complex, because this is really where the foundation of today's market divergence begins.
It is. The economic data released this morning presented a stark and, frankly, alarming contradiction. Q2, real gross domestic product, it missed expectations entirely.
We saw an annualized growth rate of just 1.5%, right?
Correct, which is well below the 2.0% institutional consensus. Yet, in the same breath, the GDP price index, which measures the change in prices for all goods and services produced, printed a scorching 6.2%.
Which is significantly above the 4.0% expectation. So let's apply our first principles approach here for the listener. Because if you're managing your own portfolio, this combination of numbers should really make you pause.
Indeed, it's highly restrictive.
Right. We have the actual economy slowing down to a sluggish 1.5% growth rate, but the prices within that economy are accelerating at 6.2%. Prices are rising roughly 4 times faster than economic output.
Which is the textbook definition of stagflation.
Exactly. So how does a regular investor make sense of a 30-year Treasury yield hitting a 19-year high in the middle of a slowing economy? Why is the bond market aggressively steepening the yield curve right now?
Understood. To break this down clearly, the bond market is steepening the yield curve because institutional investors are actively losing faith in the Federal Reserve's reaction function.
Right.
When the long end of the curve, meaning the 30-year yield, spikes to these levels, it means investors are demanding a much higher term premium to hold government debt over a long horizon.
So they see that 6.2% price acceleration, and they're looking at Chair Kevin Warsh holding rates steady instead of hiking to fight it.
Correct. And they're concluding that the central bank might be forced to just let inflation run hot. Today, the 30-year Treasury yield hit 5.23% intraday before settling near 5.217%.
So they are essentially pricing in a surrender by the central bank.
Indeed. Chair Warsh's stated objective has been to restore institutional credibility by removing explicit forward guidance. But by obscuring the methodology of exactly how the Fed weights its preferred inflation measures, that credibility is rapidly deteriorating.
Yeah, in the latest meeting, our data shows a rare hawkish split. You had 3 dissenters actively voting for a rate hike.
And the bond market is interpreting this internal fracture and the lack of transparency as a structural tolerance for structurally higher inflation going forward.
And that structurally higher discount rate is exactly what crushed the rate-sensitive sectors of the stock market today. It was just completely hidden by the headline tech rally.
Correct. If you look at our latest run of the 10-year, 2-year spread, We saw the 2-year and 30-year curve steepen by 13 basis points in a single day.
13 basis points. And real rates on the 10-year remain pinned near 2-decade highs at 2.41%. I mean, the bond market is essentially in revolt.
It is. We saw the unwinding of a record short position in August, Fed funds futures that totaled over 1 million contracts. Having a lower yield on the short-term front end, combined with a structurally much higher yield on the long end, is a highly restrictive combination for long-duration assets.
Like real estate or consumer staples?
Indeed. When fiscal deficits across developed markets continue to widen without restraint, it creates the perfect recipe for sticky, persistent inflation. The market is aggressively pricing in structurally higher nominal rates for the foreseeable future.
Moving to sector and equity flows, we have to bridge this macro reality with the stock market because if the macroeconomic backdrop is that restrictive, we have to explain why the NASDAQ 100 just posted its biggest one-day gain in months.
And numbers in technology are staggering today. Microsoft surged 15.5%.
15.5%. To put that into perspective for you, that added roughly $450 billion in market capitalization in a single session.
Which is a historic, unprecedented single-day gain for a company of that size. And it was driven largely by Azure cloud growth re-accelerating to 43%.
Right. And the semiconductor space immediately caught fire as a derivative trade. Lam Research closed up 18%. SanDisk rocketed 26%.
Micron Technology gained 18.4%. But referring back to our initial data point, the broader equal weight index dropped. Defensives, real estate, and consumer staples faced heavy liquidations.
Yeah, Altria dropped 9.3%. Fair Isaac plunged 17% purely on regulatory fears. And C.H. Robinson fell 15.4%. I mean, the divergence across sectors today is extreme.
Correct. The Philadelphia Semiconductor Index closed up only 0.08% on a total return basis for the wider index, which highlights massive dispersion even within tech itself.
So we need to unpack the mechanics here, because to an observer, it looks like everyone was rushing for the exit door on technology earlier in the week, and suddenly that door swung violently the other way.
It's a classic short squeeze dynamic.
Right. It feels like a game of musical chairs, but instead of chairs being removed, the price to stay in the game is skyrocketing. Could you walk us through the fundamental difference between genuine long-term institutional buying and the mechanical short covering rally we witnessed on our dealer desks today?
Certainly, genuine institutional buying occurs when large asset managers allocate fresh, unleveraged capital to establish long-term equity positions. You typically see this accompanied by expanding market breadth, meaning most stocks go up together, and sustained heavy trading volume.
But what today's proprietary updates show us is entirely different.
Indeed, total trading volume across the exchanges was nearly 17.8 billion shares. That is actually below the year-to-date daily average. Furthermore, the S&P 500 closed the session with a $3.6 billion market on close sell imbalance.
Right. If institutions were genuinely accumulating tech, you would not see a massive rush to sell at the closing bell.
Correct. This indicates the rally was structurally a mechanical event.
On that point, the options market positioning essentially trapped people and dictated this entire upward move.
Understood. Going into the trading session, our data showed the net gamma positioning was negative $26.6 billion. There was virtually no stabilizing dealer floor near the current price.
Let us pause and translate negative gamma for you because it is the engine of today's illusion. Imagine market makers or dealers as insurance providers for the stock market. They sell options to investors.
Right.
When gamma is deeply negative, it means these dealers are caught off balance. If a stock price starts rising quickly, these dealers are mathematically forced to go into the open market and buy the underlying stock just to hedge their own risk and balance their books.
Exactly. Their forced buying pushes the price up even further, which forces them to buy even more. It is an automatic feedback loop.
And that loop was triggered the moment Microsoft's earnings catalyzed the initial move upward.
Indeed. It quickly breached a critical psychological pivot level around 7,400 on the S&P. Because resistance was exceptionally thin above that level, those dealers were forced to buy futures to hedge their short call exposure.
And at the exact same time, hedge funds had just completed their largest three-day degrossing or reduction of exposure in information technology since 2016. They were heavily short.
Correct. When Microsoft surged, it triggered margin calls. What we saw today was the violent, forced unwinding of those short positions. Our internal hedge fund VIP versus VIP short basket posted its second biggest daily move since the initial COVID volatility.
Which confirms this was a positioning squeeze, not organic accumulation. And our flows data backs up exactly what you're saying. Traditional asset managers and long-only mutual funds remained highly cautious.
They explicitly avoided chasing this massive move higher in the AI-levered semiconductors, preferring to sit on their hands and wait for further earnings clarity.
Moving to today's data on commodities and hard assets, we really need to show you how this U.S. bond market panic and equity squeeze caused international shockwaves, because the Japanese yen experienced a massive, violent surge of over 3% intraday.
Yes. The US dollar to yen pair dropped all the way to 159.53. Trading volumes on that currency pair surged past 80 billion, structurally confirming aggressive government intervention by Japan.
So why should a standard investor holding U.S. equities in their retirement account care about the Japanese government buying yen?
It comes down to the structural vulnerability of the global carry trade. This is a crucial concept. For years, institutional investors have borrowed heavily in Japanese yen, taking advantage of their near-zero interest rates.
Right.
They take that cheaply borrowed money and use it to fund the purchase of higher-yielding U.S. risk assets, including mega-cap U.S. technology stocks and corporate credit instruments.
So when the Japanese government intervenes in the currency markets and the yen spikes violently upward, the fundamental cost of that borrowed capital suddenly explodes.
Indeed. The debt becomes exponentially more expensive to service overnight.
It is like taking out a mortgage where your minimum payment suddenly triples without warning.
Correct. This forces those leveraged global investors to rapidly liquidate their U.S. equity holdings to generate the cash needed to cover their new, more expensive yen-denominated liabilities.
So a 3% single-day appreciation in the yen is a systemic, highly destabilizing event for those leveraged structures.
Understood. If the Bank of Japan signals further normalization, or if this intervention continues, that forced deleveraging could derail the broader U.S. equity market entirely, regardless of how strong domestic corporate earnings might be.
Looking at the energy and metals markets within our daily desk data, Brent crude oil dropped roughly 1.4% to around $90 a barrel. This was reportedly on rumors of a pause in Middle East hostilities.
Yet, European natural gas storage remains somewhat vulnerable at 55%, and Russian refining capacity disruptions are sustaining medium-term inflation risks.
But here's the most glaring anomaly. Gold jumped to $4,103 an ounce, and silver outperformed with a 2.19% gain. Copper remained entirely flat. I mean, oil trading down makes logical sense alongside that 1.5% GDP miss we discussed. But why is gold surging alongside equities in what appears to be a risk-on bullish tech tape?
Understood. Gold is currently acting as a strict Fed credibility hedge. Historically, gold and risk assets like equities move inversely to one another. Seeing them both surge upwards simultaneously today is highly unusual.
The market is purchasing risk assets due to the mechanical short squeeze we just outlined, while simultaneously hoarding gold to protect against a structural loss of control by the Federal Reserve.
Indeed. When you combine the 6.2% GDP price index with the 30-year Treasury yield breaking 19-year highs, it signals deep systemic institutional anxiety about long-term inflation running out of control.
Furthermore, silver's outperformance compresses the gold-to-silver ratio, and the absolute flatness of copper, which is often viewed as a barometer for global economic health, indicates the market fundamentally doubts any near-term industrial or Chinese demand recovery.
Correct. This directly challenges the narrative of a broad-based economic expansion. In the commodity trading advisor space, our proprietary updates show pronounced short positioning in precious metals, meaning today's gold surge is inflicting severe pain on leveraged macro strategies, much like the tech short squeeze.
Moving to the synthesis of today's data, let's connect the dots across all these asset classes for you. Because what happened after the closing bell in the technology sector perfectly encapsulates the current shifting economic regime.
The market is fundamentally changing how it creates technology companies. It is no longer enough to just mention AI on an earnings call.
Right. Meta platforms dropped almost 8% in after-hours trading because investors are deeply concerned about the return on investment for their massive ongoing AI capital expenditures.
And Apple traded down 2 to 4% after hours because, despite beating iPhone revenue expectations, they missed on their higher margin services segment. They posted $30.74 billion against a $31.36 billion consensus.
Conversely, Amazon surged 6 to 8% after hours on a massive Q2 beat, specifically because their AWS cloud revenue growth re-accelerated to an impressive 37%.
Indeed, we are witnessing a strict structural regime shift in real time. The global equity market is decisively transitioning away from pure momentum trading.
We noted that in Japan earlier today, The momentum short factor actually outperformed the momentum long factor by a 2 sigma standard deviation level.
Correct. Broad market leverage is taking a significant hit, demonstrated by a $170 billion reduction in U.S.-listed levered exchange-traded fund net exposure over the past month.
In the technology sector specifically, the market is no longer willing to pay a premium valuation simply for the promise of future AI capital expenditure.
Investors are aggressively demanding hard, current evidence of AI monetization and scale.
It is the AI monetization checkpoint. We are moving from the tell me phase to the show me the free cash flow phase.
Indeed. Microsoft proved they could monetize it today with Azure's growth. Amazon proved it with AWS. However, Meta is struggling to convince institutional investors that those financial returns are arriving quickly enough to justify the spend.
If a company is building massive data infrastructure, they must prove that enterprise demand is actively generating free cash flow today, not just in some theoretical 5-year projection.
Understood. When you combine this strict new fundamental requirement with a macroeconomic environment where the discount rate is governed by a 5.2% 30-year yield, the mathematical margin for error for these mega-cap tech valuations dropped to zero.
Pulling this all together for you, today was a masterclass in why you must look under the hood of the headline index numbers. A historic $450 billion single-day gain for Microsoft catalyzed a violent mechanical short squeeze that masked a deeply fractured underlying market.
Underneath that surface-level tech rally, defensive stocks and rate-sensitive sectors were actively crushed by a bond market dealing with 19-year high Treasury yields.
And genuinely stagflationary economic data, and a Federal Reserve facing a severe credibility crisis.
On that point, the core takeaway for you as an investor is absolute vigilance. When financial media headlines broadcast record index gains, it is imperative to check whether the broader market is actually participating in that growth.
Or if the indices are simply being dragged upward by a handful of heavyweight companies squeezing heavily leveraged short sellers.
Correct. The negative market breadth, the massive market on close sell imbalance, and the relatively low trading volumes confirm that today was entirely the latter.
It was a mechanical market reaction, not a fundamental shift in economic reality.
Indeed. Which leaves us with a critical, provocative question to consider regarding your portfolio going forward. If the broader market is crumbling under the weight of 5.2% long-term yields, and the only thing holding up the S&P 500 is the future promise of artificial intelligence, what happens to this entire house of cards if the next wave of tech earnings fails to prove that AI is actually profitable?
Thank you for listening to Market Pulse by Orestes Capital. We're Elena and Marcus. We'll be back tomorrow with the latest market color.